Hey there, everyone. Welcome to Chart This with Dave Keller. It's Tuesday, May 6th, not March 6th, as I incorrectly said yesterday. It is indeed the month of May. I promise I knew that. Sometimes the brain and the mouth are not in full agreement as to what's going to come out, but we are on May 6th, 2025. Welcome to the show. I'm Dave Keller, founder of Market Misbehavior, coming to you from a beautiful summery day here in Redmond, Washington. Highs in the mid 70s, lots of sun. I'm a few minutes late because I had lunch and a long walk through the woods with my wife. I'll take it anytime. Pleasure to be with you here today, as always. Had a really good interview earlier today for the Market Misbehavior podcast. You can look for that episode to drop here probably this evening or tomorrow morning with Megan Horniman, the Chief Investment Officer of Verdance Capital Advisors in Baltimore. Great macro discussion, perfect discussion for Fed Week, inflation, recession, all the catchphrases, all the words that we've been hearing about. Asked a lot of great questions. I hope that that elicited some really interesting insights from Megan on how they're navigating this market environment. I hope you find that it nudges your own thinking as well. All those interviews, by the way, including my interview last week with John Roque, which was a lot of fun, on my YouTube channel called Market Misbehavior. We're live streaming on Facebook, YouTube, LinkedIn, and X. I appreciate you guys tuning in live. Those of you that are doing so, please drop questions as we go. Anytime it pops into your head, any of those comment sections of any of those platforms, I can see it here as we live stream. I'll take a question or two at the end of the episode. Anything we don't get to, we'll put it in the mailbag for our Friday mailbag episode. Sort of a distribution day. I would argue the sell-off that we saw at the end of yesterday's session continuing into today's session. Let's look at the evidence and talk about what happened to the major benchmarks. Not an end of the world kind of sell-off, but certainly not the resilient breakout above the 200-day moving average I think many investors are anxiously awaiting. Yesterday, if you watched the show, we highlighted the last hour of trading, which is often a really good indicator of institutional rotations, right? Institutional trading, because they usually save the big moves for the end of the day. That's when a lot of the volume kind of comes in. Yesterday, going into the close, quite a bit of distribution, giving back a lot of the gains from the course of the day. Today, opening a lot lower, rallied into the lunchtime hour, but then weaker going into the close. We finished just above 5,600, but not by much. The S&P finished today just right around 5,607. That's down about 0.8% from Monday's close. The NASDAQ composite down 0.9%. The Dow down just under 1%. All three of these down a similar amount. Mid caps, small caps, all about the same. The small cap S&P 600 down about 0.6%. But again, all sort of directionally, sort of the contours of the day, very, very similar. Volatility continuing to increase. We had a huge spike of volatility with the VIX going above 50, going into the early April market low. From that rally that we've seen from early April now to early May, we've seen volatility decline, still remain what I would argue is at least medium volatility, if not still high volatility. But this week, you're actually seeing the VIX drift higher. So as of today's close, we're just below 25, up just over a VIX point from yesterday's close. So, when you think about this market environment, questions on this front page of the stock charts market overview that I would keep in mind. Number one, does the S&P power above 5750? That's where the 200-day moving average is right now. The NASDAQ kind of in a similar position below its 200-day. Those get above their 200-day. I think that's remarkably bullish. But if they fail to do so, that's really not bullish. The second thing would be volatility. And if you see volatility start to increase in any meaningful way, VIX above 30 would pretty much tell you, the house is on fire kind of sell off. That would be a pretty volatile environment and most likely in a period of distribution. Third thing I'd be looking at on this front page is the action in small caps. I've been waiting for small caps to outperform. It certainly has not happened. As much as large cap growth dominates returns, it's not going to happen. But if you would start to see a series of days where small caps significantly outperform large caps, that for me would probably be kind of a danger sign here, because what it tells you is the big growth stocks are no longer driving returns. All right, let's look at some other asset classes here. Interest rates generally moving lower. We can see the 10-year point down around 431, the 5-year point below 3.9%. The long bond yield just above 4.8%. Obviously, we have the Fed meeting this week, today and tomorrow. Fed announcement tomorrow, and so an interesting one. I mean, and to be clear, 0% chance the market pricing in that there's any policy change at tomorrow's announcement. Certainly, I think the action will not be in any sort of change in the target rate, but more about forward-looking estimates of Fed activity, right? What the dot plot is, meaning the different Fed governors and where they expect interest rate policy to go. Any expectations in the Q&A or color about where what sort of starting point we might see for a first Fed lowering here for this cycle. And in an interview with Megan Horniman that I mentioned, again, should be out here very soon, we talked specifically about the Fed this week. So I'll hope to get it out to you as soon as possible so you can check it out. In her opinion, just to give you the punchline, no change this time. But her comment was it's important, the Fed doesn't want to overcommit. The moment they start lowering rates, it's not like they can just go one on, one off and just like lower rates and then not lower rates. Like the market wants consistent. They want to know we're in a rate cut cycle, we're in a rate hike cycle, we're in a pause. Just randomly moving it month to month or meeting to meeting is not an ideal setup. That pretty much just injects uncertainty and probably volatility into the markets, which the Fed's most likely trying to avoid. So, expect them to wait until really necessary to make that first rate cut. I'll let Megan give the full answer in her words as soon as you get the interview out here. But rates moving lower, and the reason why I brought this up, I forgot to come back to, is the fact that she said, remember that the Fed controls basically the short end of the curve, right? Those are short-term kind of overnight rates that the Fed is actually manipulating. The long end of the curve, the 10-year point, the 30-year point, the Fed really doesn't have any direct influence on those rates. Those are more driven by free market forces. And so, it's not like there's much Powell can do to lower the 30-year yield or raise the 30-year yield indirectly and through inference, maybe, but not with any sort of policy decision. So remember, there's that lag and there's that gap between what the Fed might do and then the long end of the curve, which is really what defines borrowing costs. And, your mortgage rate and things like that are more tied to long-term rates, which the Fed really can't directly influence, unfortunately, or fortunately, depending on who you ask. Precious metals back in the driver's seat. Gold, after last week being in full pullback mode, and we've been bullish on gold for a while. Hopefully, you've picked up on that not so subtle thing because I brought it up often because it's just a good chart. And in a period when stocks have been so questionable, I think gold has been unquestionably bullish in terms of its trend and momentum characteristics. So in the last week, I fielded a lot of questions about, was that the top on gold? Is it over? How low does it go? All these things. And my general feedback has been, which remains this day, it's a short-term pullback until proven otherwise. And this week, we're seeing that bounce back higher. Gold, the GLD is still above the 50 and 200-day moving averages. Gold pushing above 315 today. That's up about 2.8%. Copper, silver prices all bullish. Crude oil prices back higher. The energy sector has been one of the more volatile sectors with the big swings that we're seeing in crude oil prices, coming off of a very low level, maybe making a double bottom on the chart of crude oil, but the USO up about 3.5% today. Energy just below utilities at the top of the return list today. All right, finally, cryptocurrencies. We shared on yesterday's show and had a number of great comments supporting this chart, which was looking at the volatility in the IBIT, which is one of the Bitcoin ETFs. That's the iShares Bitcoin ETF. And how basically it's been a leveraged stock ETF, right? In January, it's outperforming the S&P and the NASDAQ on the way up. On the downside from February peak to the April low, it's underperforming the S&P and the NASDAQ on the way down. And then in the month of April, it's back outperforming on the way up. So Bitcoin has essentially been, the S&P on steroids to the upside and the downside, really more, following other risk assets, not really differentiating much. And I think that's kind of one of the benefits of what we've seen with gold is has what we call a differentiated return profile. It tends to have a low correlation to stocks. And that means it's a good thing if you're trying to diversify usually. All right, looking at the 11 S&P sectors, you can see only 2 of the 11 in the green. Is what we call sector breadth. This just looking at how many sectors finished positive or negative. The XLU up 1.2%. Energy and communications basically flat. Everything else was down today. On the downside, you can see healthcare XLV down 2.8%. Industrials and consumer discretionary both down about 0.9%. Boy, healthcare has gone from looking kind of okay to kind of not okay. And I would argue kind of ugly right about now. We grabbed a chart of the XLV, which we'll show later. You'll see when we get to the market carpet, a lot of red concentrated in the healthcare sectors, a lot of names in there, some earnings happening, but overall the price action has been relatively weak. And the relative strength is what's most concerning there. In my interview with John Roque last week, we talked about the benefits of relative strength investing, focusing on what's leading and what's lagging. And, healthcare is underperforming, right? The relative strength line is going down. You want to avoid. One of the things we talked about as a warning sign would be a surge in utilities. And here we are seeing it up 1.2%. Too early, I think, to call it the return of the utility sector, but certainly something to monitor. CEG, Constellation Energy, one of the utilities names, up pretty big today. Top performer in the S&P, as I see looking at the old market movers section. All right, looking at the breadth today, much more on the downside than the upside. You can see for the New York Composite Index, 57% declining, 40%, 39% advancing. On the S&P, a little bit worse, 28 up, 72% down. It's about a 3-to-1 ratio of stocks down versus up, 2.5 or so. So definitely distribution that we're starting to observe this week, with yesterday weakening into the close, with today's distribution going into the Fed meeting. Certainly a nice rally, but pullback so far this week going into this week's Fed meeting. What to expect from tomorrow on the Fed? I mean, volatility, right? And from 2 o'clock, expect no real change unless there's some big change in the language that's reported right at 2. But what's much more likely is you see a lot of volatility 2:30 to 4 p.m. That's where the press conference and Chair Powell will be fielding questions. That's where there will be a lot more focus on the long-term trajectory for Fed rate cuts through the course of 2025 and any change in expectations there. So certainly expect some volatility there. I think the real question will be on Thursday's session. Once we've digested what we heard from the Fed, once we kind of wrap up or get very close to wrapping up earnings, that's when you really see how the market, where it takes it from that point on. Looking at the Magnificent Seven and Friends, Netflix up 1/3%. It's interesting. The headline, one of the headlines in the last 24 hours, I want to say, or in the last couple of days, it's a blur of headlines these days, but the one about in the movie industry and doing tariffs on movie production. I would think that weighs on Netflix, right? Because Netflix does a lot of stuff outside the U.S., but not today, right? Up about 1/3%. I wouldn't be surprised if that ends up being more of a discussion point we talk about in the coming days and weeks. But for now, Netflix doing okay on that news. Apple down slightly, Nvidia down slightly. You get down to Meta down 2%. Now that's a problem because Meta is one of those stocks that has regained its 200-day moving average. And I would say the argument right now is, can Meta hold the 200-day? Days like today make that feel not as likely. Tesla down another 1.8%. That's certainly been one of the worst performers within this basket of stocks. Amazon, an earnings name from last week, continuing to frustratingly remain below its 200-day moving average. All right, let's get to the market carpet. As a reminder, I can't see all the questions and some entertaining comments so far on YouTube, X, LinkedIn, and Facebook. Thank you guys for tuning in live. Drop questions in as they come, and we'll answer a couple at the end of today's broadcast. This heat map that we're looking at really tells the story of different areas of the market. Now, one quick change, if you follow the show, the way that stock charts design this visualization, these sectors will move around. So communication services, healthcare, consumer discretionary, if the size of the sector changes in order, they could change in a physical location. Just be wary if you look in a certain place and it looks like a sector's in a different place. I think the way that it's designed, they could move around a little bit, and it's happened before. So just keep that in mind if something looks a little different. Having said that, I'm immediately drawn to the weakness right in the middle of the heat map in the in the healthcare sector. Eli Lilly down over 5% today. AbbVie, Merck both down over 4%. United Healthcare, Thermo Fisher, Amgen, Danaher, Vertex, all of these having pretty decent down days. Now, most of these charts have not been great, right? And I mean, I think the average, like an Amgen, has looked pretty bad. And it bounced a bit in April, but not enough where it really started to look encouraging again. I think the problem more are charts like Gilead, which did start to improve. and felt like they might be recovering, and now are rotating a bit lower. What's another one that's kind of, yeah, Vertex is maybe a good example of that. Right, Vertex, I mean, kind of a different chart because it really wasn't, performing remarkably well, over the last 8 to 12 months, right? Sort of flat during this period while the major averages were going up into a February peak. But we're kind of bumping up against resistance here and then gapping down 10% today, failing to get above there. Moderna, another name, right, rotating lower. And charts like that have been bad for an extended period of time, but there are other names that were sort of the outliers that were doing well, and those are being dragged down again. So the healthcare sector, I mean, for me, it's like there are all these times where it looks like it might be turning into something. Looks like Pfizer might be regaining the 50-day, but then it doesn't happen. So where are we at the end of the day? I mean, charts like this are below 2 downward sloping moving averages. It's demonstrated its consistent inability to regain moving average resistance. The RSI has stalled out at 60 starting last summer, right? So from the last July peak, which is the most recent major high. After that, every little short-term rally has seen the RSI stall out around 60. That's where we talk about the range rules of RSI and paying attention to that, because in a bullish environment, the stock rallies and you get above that 60 level because that demonstrates that there's a lot of momentum coming in. There's an excess of buyers willing to push prices higher, and that's just not what we've seen here in the last 8 or 9 months from charts like Pfizer. And I would say generally, again, I grabbed the chart of the XLV in a little bit. You'll see that on the sector chart, kind of the same thing. Other random names in red, kind of peppered around the heat map. TransDigm is one of those kind of tough reversals. And sorry, I'm going totally off script, but just wanted to grab some of the names on the heat map. TransDigm made a new all-time high yesterday, right? This week, it's making a new 52-week high, finally getting over those October peaks, finally clearing $1,400 a share, looking like that's sustained today, down about 5.5%. Now, still not a horrible chart and still above moving average support, but certainly, changing its character, at least for today, from a significant breakout that felt like the beginning of something much more significant to now pulling back a little bit. Not a broken chart, not an end of the world pullback, but certainly suggesting maybe there's a red flag there. And if that's something I bought on a breakout, I would be very clearly defining my downside risk and just think about what sort of downside move you can deal with, you can accept for the possibility to ride the next leg higher. That's kind of the question you have to ask on that kind of chart. Palantir, we grabbed and will show in our chart review portion because that was down big today. Palantir has had a brilliant recovery, recovering 100% of the sell-off from February to April back to a May peak, retesting that previous all-time high. And today, just giving it all back and dropping down another 12% today. We'll look at that chart here in a few moments. Only other thing that I would say, besides, I mean, a lot of things were kind of neutral today. Look at the sort of old school telecoms, AT&T, Verizon, mobile names like T-Mobile. AT&T is not a bad chart today, right? And I run a scan regularly on stock charts for charts above 2 upward sloping moving averages, what we call moving average proper order. Each of the moving averages in the correct order, which implies a consistent uptrend. AT&T kind of fits that description here. In the environment we've seen in the last couple months, fewer and fewer stocks have sort of been in this configuration. I think that's important to note when we find stocks that it's retesting previous all-time highs with a decent dividend yield. Could be an interesting name to watch for sure. All right, we're going to talk about seasonality here in a moment. Just wanted to take a brief moment to thank my friends at Seeking Alpha. It's been a great partnership working with them. Good group of market practitioners. I interviewed Steve Kress, the head of the quantitative research group at Seeking Alpha, earlier this year on my podcast. We talked about their quant model, how they use it, and how they weigh different factors and evaluate the model, and how it's combined with things like strong dividend pairs, consistent dividend pairs that score well according to their quantitative model. They are doing a spring sale with my partnership with them. You can use the code, actually use the link, marketmisbehavior.com/Seeking Alpha. You get $30 off Seeking Alpha Premium, and they will also throw in their next Alpha pick for free. And that's where they hand select one of those names to feature and dig into a little more deeply. You can scan the QR code for more information on their spring special. or go to marketmisbehavior.com/seeking alpha. It doesn't cost you anything more. It actually gives you a little better deal, and it helps me make market misbehavior awesome. So check it out if you like. All right, let's talk about seasonality here. I've had some questions on sell in May and go away. I may do what I've done a number of previous Mays, is do a webcast later this month, digging into this in a little more detail. But I just want to show you a quick preview of that meal we might eat together later this month. When we talk about sell in May, which you have to remember is in the last 5 years, right? 2020 to 24. So sort of in the COVID to post-COVID era, May has been a winner 100% of the time. Each one of those 5 years, May has been positive with an average return of positive 2.2%. July has been up 100% of the time, up 4.4% on average. June is the worst one, only up 4 out of the last 5 years with an average turn of 1.2%. So sell in May is usually not as much about weakness in May and June. It's usually about weakness in August, September, October, which is where you consistently have weakness. And if you look at the last 5 years or the last 5 decades, September and October tend to be pretty bad and probably the worst time of the year. Most major lows have tended to happen around that period. So, I'm not a fan of just blindly selling in May. And again, if you look at recent evidence, May has actually been a pretty consistently positive month. But when you get to this time of year, it's usually a really good time to start looking for the market to roll over, because it's usually happened in the summer and it's usually led into a fall low. There's no guarantee that happens. And I can cite some years over the last 20 years where the complete opposite has happened. But this is more on averages. This is more on tendencies. And those tendencies are very much true. So seasonality, actually, just in the last 5 years, says May, June, July is actually not that bad of a period. Usually the market holds in okay. It's going into late summer, into the fall, when things really start to be kind of rough, right? So spring is usually okay. We're just getting near that period where we often get sort of a major top. So it's less sell in May, but start being ready in May. That's just not nearly as catchy or memorable, which is probably why we don't say it and we go a sell in May. Having said that, I might do a webcast later this month and dig a little more into seasonality and a little more nuances in what I just described. But that's where we're at seasonally. All right, let's look at a couple of charts here. I didn't mean to include that, so I'll skip it to the daily S&P chart. Actually, I have the wrong list. That's why. Okay, we go to this one. There we go. That's where we want to be. Here is the daily chart of the S&P 500. What has happened? I think this week is all about the 200-day moving average. It's currently around 57.50. It's been flat for the last couple of weeks. It's really been flat for the last month or 4 to 6 weeks, basically because of the big spike in February, the big pullback into an April low, the big rally. We're literally sort of chopping all around those middle levels. And so with the S&P between 5,500 and 5,800, I would generously give on the upside. I think we're neutral. I think the stop light is yellow. I think anything below 5,500, if this is the beginning of another drop, I think we get below 5,500. That's where I would feel pretty comfortable playing the short side and thinking more about a retest of the lows and what that might look like. If we break above the 200-day, if we power above 5,800 and clear those lows from the end of March, I think this is a pretty bullish technical configuration. And again, regardless of what you think about the macro environment, the chart doesn't care what you think is going to happen, right? And that's what technical analysis, I would argue, is about. It's not about predicting the future. It's about having a windsock, right? I mean, I've spent years trying to fly airplanes. I still have a ton to learn along those lines. But you learn a lot about windsocks, right? The windsock having a certain look doesn't guarantee that your landing is going to have a particular wind configuration, because the wind's actually kind of variable, but it does give you a general sense of what are the conditions here. And Carl Swenlin, who is a longtime stock charts contributor and a fantastic technical analyst, says technical analysis isn't a crystal ball, it's a windsock. It doesn't tell you what's absolutely going to happen, the future. It tells you the tendencies, and then you analyze the trends and how they evolve. So I think thinking of the market like a stoplight, thinking of a neutral phase, what would make it a very bullish phase that you want to follow? What would make it a bearish phase that you'd want to follow? That's what I think is helpful in this environment, to sort of clearly define your risk and your reward. We've had an incredible rally off the April lows. The real question now isn't, did we rally? We did. Is there sustainable momentum beyond these points? And that's where I'm pretty skeptical until further evidence changes that. Some things that I'm watching, and again, there are a number of things to watch. I wrote an article on stock charts. Is that true? Where did I write it? It's a bit of a blur. I think that was my show on Stock Charts TV yesterday. We talked about some macro technical things that I was following. And I did not talk about the McClellan oscillator. I did talk about bullish percent indexes, which will show next. But I think in this environment, right, you sort of define where you see the market going. On the tactical time frame, we've been in an uptrend undeniably from early April to early May. So now that we know we're going up on that tactical time frame, the question is, what would tell us we're no longer going up? The S&P, holding resistance, failing to hold support. That would be an obvious way. The McClellan oscillator, which has been very strong and actually toward the highest levels we've seen in the last 12 months, breaks below the zero level, right about where we've been at the last couple of weeks. That's kind of where we were in mid-January. That's kind of where we were in mid-July of last year. Both of those, the next 3 to 4 weeks were actually pretty weak on the short term. So do we see a rotation down after that extended McClellan oscillator? Again, breaking below the zero level is the real signal telling you that there's a short-term period of distribution. Look here after the February peak. Look here at the late March peak when we flip below that zero line, and that's a sign that things are actually getting a little less constructive on the short-term breadth side. In terms of short-term breadth, I want to highlight this is the bullish percent index for the S&P 500. This is a breadth indicator based on point and figure charts. Simple question is, what's the most recent signal for each of the S&P 500 names? Is it a buy signal or a sell signal? This is the percent of stocks where the most recent signal was a bullish one. It's right below 70%. It's like 69.8%. And the way that I use this is a break above 70% tells you to get ready. A break back below 70% tells you look out below. And you can see previous times where that's happened. It's not perfect. There are times when we break below zero and it's just a brief drop. But a lot of more significant drops have sort of started with that indication, right? That extreme bullish breadth and then rotating back below 70%. So we're arguably right at that point. We'll see how the next couple of days play out, but certainly something I'm keeping an eye on to gauge a potential drop. Other breadth indicator that I'm looking at, the percent of stocks above their 50-day moving average. We broke above 50% last week. We are now dangerously close to breaking back below 50%. The last time we had that happen was in late February before the decline into March. We have still about 40% of S&P stocks above their 200-day. That's below 50%, which is the bullish threshold. So we're still seeing long-term breadth conditions pretty weak. We still see the major averages below the 200-day. I'm watching those short-term breadth indicators that I've mentioned here recently to see if that identifies a tactical pullback. Gold continues to be strong. As a reminder, I do have a position in the GLD and the IAU. I think those are probably the two gold bets I can readily come up with in my own portfolios. And I hold that for the simple reason that the chart looks good. And it has been in a consistent uptrend for quite some time. And I've added that to that position during this bullish phase. And I've been very happy with that performance. And what tells me to remain in that trade? Well, again, as we've talked about many times, when a chart is working, it can be very tempting to take some of that bet off. For asset allocation and reducing an overweight, that's beside the point. I just mean, do you want to reduce your position to take profits? And I would say no. I mean, what I've learned is you let your profits run as long as possible, right? Otherwise, we are pulling our flowers and watering our weeds. So if a chart is good and it remains good, we want to keep that position on and ride that outperformance as long as possible. Gold's still above 2 upward sloping moving averages. The recent pullback that we've experienced over the last week, the RSI didn't even get below 50. So this is still in a primary uptrend, according to my methodology, tells me to remain bullish until proven otherwise. Microsoft continuing to hold this upside gap that we had on earnings last week. There was the gap last week. I think that was Wednesday's report. Thursday's gap higher. We opened around 425, continued to go higher. Last Friday, yesterday, and today, we're literally in the same price range. So Microsoft has not given away any of those gains, but it's kind of stalled out a little bit here. Reminds me of a kind of a power off stall. That's not true. A power on stall, for what it's worth, right? You're sort of, going higher, and then you stall the engine and it sort of shudders a little bit. And if you do it right, you lose a lot of altitude. You just don't make any more progress higher in altitude. That's sort of what it feels like. Feels like our climb has tapered off for a bit. we're not really going down. And I think 425 is the level I'm watching. And I think I have an alert set, but I'm going to check that after the show and make sure that I do. 425 is what I'll look at there. But I think as long as we hold 425, this is pretty good. We became overbought on that gap higher. We're still overbought as of today's close. Something to watch. I think breakdowns, if charts like Microsoft can't hold that gap, that would be bad. Same with Meta, which gapped higher and gapped above the 200-day moving average. On Thursday of last week, we closed back below, but then Friday back above. Monday about the same. Today actually closing near the lows of the day, down about 2%. I think both of these look like very, very close to breaking that support level. So I'm keeping an eye on the upper end of those gaps. And if those hold, things are good. If not, I think that's a problem. Now, Apple and others look very different, right? Apple, I would argue, still in a primary downtrend below 2 downward sloping moving averages this week, sort of continuing the gap lower that we saw after earnings last week. Here's Amazon, trading below the 50-day moving average, 200-day moving average actually flat right about now, but overall, momentum dead even. So Amazon's kind of stalled out, but not really giving the break to new, break above the 200-day moving average on stronger volume kind of vibes. It's more of a wait and see kind of tone. So the problem here is mega cap growth generally not in the driver's seat. I mean, in 2025, I think still, as we talked about at the beginning of the year, ends up being more about value than growth. I think at the end of the year, we'll probably look back and see how that's been the case. But for now, we'll see how some of these mega cap stocks do. One kind of painful story in the technology space is Palantir down about 12%. Now, this is a huge swing from a peak around 1250 to an intraday low around 65 and change, to an intraday peak yesterday, right back at around 1250, and today down about 12%. That's a big drop from yesterday to today. And the problem is that's starting to make what looks to be a major league double topping pattern. That's not good. And it's not good for the chart of Palantir. Now, that being a double top on its own, I just think of it as a key resistance level. If I was not owning Palantir, I don't own Palantir individually, perhaps through an ETF that I own, might have exposure there, but not that I've intentionally made. I think the trick for a chart like Palantir is if you miss this move, I certainly don't think I would be adding to it at this particular moment, because you wait to see if we can clear that. So, a pullback arguably could be one of the best things to happen, because that gives us a higher low, and maybe a pullback to like the 50-day moving average ends up being an awesome entry point to ride the new leg higher. But we're overbought as we retest the previous highs, not enough momentum to clear it, and rotating lower. That's not the only stock kind of failing to get above resistance. That's one of those kind of concerning themes I'm seeing develop this week. DoorDash is another one, obviously an unrelated name, different business, but basically attempting to get above those February peaks. And we've had a couple rallies that have stalled out before they've gotten above that 215 resistance level. So I would say overall, Dash is a great chart over 215, but until then, it's sort of a wait and see type of chart. Tesla is another one, going back to some of those FANG stocks like Amazon, right? Struggling to get above the 200-day moving average. Charts like Meta actually did get above the 200-day. Tesla, however, unable to do so. Currently stalling out around 290. That's after the latest attempt to get above this level. We're kind of in limbo between the 50 and 200-day moving averages. But again, I think Tesla over the 200-day is a pretty interesting chart. Below the 200-day, I just don't see the reason to jump in, possibly prematurely. Here's the XLV. We highlighted how a lot of the healthcare names are some of the worst performers today. The XLV, arguably in a big downtrend channel. I drew this channel taking the highs, and then I drew a parallel channel, which lines up pretty well with the lows. And then I drew kind of a midpoint, just eyeballed it, just to show kind of where we're at within the channel. And you can see that this last run from late April got us basically half of the way back to the upper end of the channel, and now we're stalled out. The XLV down 2.8%, worst performer. The RSI didn't get above 50 on this rally higher. The relative strength obviously rotating lower. Healthcare as a sector bet, not a great technical configuration, I would argue. For now, it's in a clear downtrend channel. The relative performance tells me to avoid, right? To wait until there's something to get excited about. Speaking of something to get excited about, good news in the nuclear space, I guess, in terms of additional spending. Constellation and other names with exposure to that particular area of utilities doing quite well today. CEG up over 10%, finishing the day around 273, 274. That now completes, I would argue, a rotation back above the 200-day moving average. I think this is a constructive chart. Previous resistance, you can see over here, this gap down, which ended up serving as resistance there. That's around 350 to 300. So there's your upside target, I would argue, sort of getting back to this general range. Then we reassess and see what happens. But for now, a stock actually continue to rotate higher, improving relative strength when so many other things are struggling. IBM, kind of an interesting chart, right? And I think breaking above a new swing high, I think clearing this short-term resistance in April, it's around 250. Pretty interesting. We're sort of right there. We'll see if there's enough momentum to follow through. I think the bull case, you get a break above 250. You see the RSI push above 60. It's not quite there, but that's after a pretty nice bounce off the 200-day moving average. Working to the upside, up 18% today on earnings. Similar to a couple charts ago, was that CEG and Upwork look like almost identical charts. We're gapping higher, clearing the 200-day. I'm looking at resistance at the previous highs around 18, but overall, I like the action and I like the push to the upside. Whew, that'll do it for today. Let me, for the charts, let me take a question or two, and we'll take it from there. Patrick, HIM's honorable mention. I didn't grab it for the chart review, but I almost did. I kind of ran out of charts, and I thought we might go long time-wise, so I skipped it. But now you asked about it, I have to go there. There's a group of charts that looked very, very similar, names that had bounced off of their 200-day, like IBM, now, rotating above previous swing highs. That's a really interesting chart. I haven't dug into the earnings report. You mentioned on positive financials. I appreciate that heads up. I would say from a technical perspective, what's interesting about this, we tested the 200-day, the RSI held 40, and now we're rotating back higher, breaking a new swing high. I think that's a really interesting chart back in a green light, right? If you think of it like as a stoplight, the yellow light's kind of in here, red light below the 200-day, yellow light kind of in this range between the 200-day and the swing high. We're in a green light period, right? Above those previous swing highs. I think that's an interesting chart as well. All right, let's take one more. Yeah, I saw a couple comments about the headlines again. There's not enough time and space on this show to go about headlines. I did see the India-Pakistan, attack. That's something certainly to follow for sure. Again, the impact on the markets is how I usually just try to think of it for my efforts here. Limited for now, but we'll continue obviously to see if that grows into a larger conflict. That certainly could have some significant impact. Final question, Richard. Thanks so much for watching. Will I be at the Fed press conference? Not my game. Boy, that'd be fun to go to sometime, though. I don't know if I could drop some random question to Powell about the 200-day moving average. I'd probably do that once and then get kicked out and never get invited back. Thank you guys so much, as always, for watching. I appreciate you tuning in live. If you're watching our replay on our YouTube channel, I appreciate you as well. Look for our latest podcast interview with Megan Horniman of Verdance Capital Advisors. Also, please check out our latest interview with John Roque of 22V Research, a guy that I've learned a lot from, and a really great perspective, longtime technical analyst, fantastic analogies for relative strength in investing. I hope you enjoy them all. For Market Misbehavior, I'm Dave Keller. Have a great evening, and remember, it's always a good time to own good charts. Take care, folks.